Let's get a lowdown today of July's inflation result with the research head and chief economist at Security Bank, Angelo Taningco. Good to have you again, Jello. Welcome to the program.
Thank you for having me, Kathy.
All right, so you predicted 1.2%. It's far slower than forecast. What do you make of the result?
Well, indeed, it's a downside surprise on the July inflation print, and that's within the BSP's target range. So I think it's mainly due to the lower food inflation. If I'm not mistaken, it has turned negative already last month, primarily because rice inflation continues to be at mid-teens negative rate. And also, for that report, we saw vegetable prices, I think, lower together with fruits. So mainly the food inflation slowdown has driven CPI inflation to be lower.
You know, that's a conundrum. It's turned negative, as you mentioned, but then when you check at the markets and with people, inflation is still a big concern. The latest Pulsation survey said it is their biggest concern, even as inflation is slowing. Why?
Well, over the past 3 years, we saw cumulative inflation reaching, I think, mid-teens for 2022. It was close to 6%, similarly in 2023. And 2024, it went down to 3.2%. So the rate of increase in consumer prices over the past 3 years were faster, but now it's at a slower pace. But the current price level remains, I think, elevated compared to, let's say, over the past 10 years or so.
Why is that the case, that the price remains elevated? What's keeping that from coming off?
Well, we rarely have what we call deflation or falling prices, just like in the case of Japan a few years back. So we continue to have sequential consumer price increases on a month-on-month basis. I think in July it was 0.2%. And we think that for this month of August, there could be some spillover effect coming from the tropical storms that occurred late July. And therefore, that could bring CPI inflation back above 1% for this month and also for the subsequent months.
So it's really cumulative effects. And then the household debt, which also becomes a problem because people don't want to spend more knowing that they have a lot more debt to pay.
Yes. Last night, we saw also the latest Universal Commercial Bank growth on loans. It was, I think, at 12% year-on-year for the month of June. But in terms of the loans for household consumption, it was at 24% year-on-year. And this has been the case for several months already. So households continue to depend on financing to support their daily spending needs.
Rice is very important as that comprises the biggest portion of our CPI basket. Now the government is talking about increasing tariffs on rice to 35%. What impact do you think this might have on inflation? Could it bring inflation back at a faster rate, and how quickly?
Since the tariff cut was made in July of last year from 35% to 15%, that contributed to the decline in the inflation in the second half of last year, up to the first half of this year. If the government will raise the tariff rate back to 35%, then CPI inflation will, of course, go up, but we estimate it could be 30 basis points higher for the overall CPI inflation. But rice inflation, which has been in negative territory over the past 7 months, will likely be positive again, and that's also partly because of base effects since global rice prices have been much lower this year compared to last year. So the tariff rate hike will clearly raise inflation, but at a modest pace, we think, and therefore the full year inflation this year will still be lower compared to last year's 3.2%. With our full year forecast pegged at 1.9%.
So does it make sense to actually raise tariffs at this point or at all? What's your opinion as an economist?
Well, I think in order to raise tax revenues, that will be a help in terms of contributing to the narrowing of the fiscal deficit by improving the tax effort of government. And therefore, given that inflation is already benign, it may be a good time to start raising the tariff because it will not exert that sharp inflationary pressure as inflation will still remain within the central bank's 2 to 4% target at a lower end or perhaps a notch lower than the minimum of the target.
So taken all together of what we've discussed about the potential of higher tariffs and rice and also household debt and also the pace of inflation at which it is increasing, what then for the Bangko Sentral? Does it have more room to lower interest rates?
Well, with this downside inflation surprise, this provides more room for the central bank to continue its monetary easing, as it already signaled to the market more rate cuts, at most 2 by year end. But for us, we think that they will still look at the upcoming second quarter GDP growth data. Our forecast there is at 5.6%, which I think is a notch higher than the consensus of 5.5%. But if it turns out to be another downside surprise for the GDP, then probably the central bank could cut another 25 basis points in order to underpin economic growth at a time when inflation is already benign.
Just as a final point, that 75 basis points of a rate cut in totality, what impact then would that have on the peso?
Well, clearly, this will exert depreciation pressure on the Philippine peso. Yesterday, the peso strengthened sharply by more than 1% in reaction to the weaker than expected U.S. labor market data. So the dollar peso already trading below 58. If it continues to trade close to 57, which is, by the way, our year-end target, then we think that the peso will still be resilient in light of these headwinds down the road in terms of higher inflation and still growth at sub 6%.
Got that. Well, thank you so much for the update. Angelo Taningco of Security Bank joining us.